Good afternoon, ladies and gentlemen. Welcome to the 7th of July, double seven of weekly market review. I have with me today Gerald. How are you, Gerald?
Very well. I think for those who are invested in the markets, we see that both the Singapore market as well as the US market have done very well over the past week. Many of these indices are at all-time highs. So hope to be able to share some of these updates with our viewers today.
Yes, indeed, it has been a good week. 4th of July was the Independence Day in the US, so managed to catch a bit of sleep last Friday. And the economic data, the non-farm payroll data, as well as the ISM manufacturing and service PMI data were all very positive and strong, signaling that the tariff has no impact on the US economy yet. And this morning, we saw that the Trump administration also announced the pushback of the tariff, which was the deadline, which is 2 days later now, July, to 1st of August. So market is beginning to get used to this tariff threat, and we foresee that this is likely going to be less serious than what was announced on the in the early April period. So market is at all-time high now, and I'll let Gerald take us through some of the developments.
Sure. So today's sharing is for informational purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, you can go to this website, sias.org.sg/membership, or scan the QR code. And as a SIAS member, you can access various online resources as well as investor education programs. So what we saw for the past week is that we have got many different indices hitting new all-time highs. We see the S&P 500 closing at 6,279 points in the shortened trading week with a 1.7% gain over the past week. The STI also closed at above the 4,000 level. So that is actually a significant milestone for the Singapore market with a 1.2% gain in the past week. Okay, what actually triggered this rally apart from what Sunny shared earlier, which is really the expectation that the tariff threat would not be as significant as before. We also saw continued strength in US economic data. This is the US non-farm payroll data, and we saw that the jobs market in US remains very strong. So overall, we see that the number of jobs created is actually above the market expectations and also above the level that was in May. So despite all the concerns that the tariff will lead to an economic slowdown, we actually see that there has been continued strength in the US labor market. So with that, we also see some updates in terms of the expectations of the Fed interest rate decisions. This is the latest CME Fed Watch 2 data that I tracked last night. And what we see here is that for the upcoming meeting in July, investors are almost certain that we won't see a rate cut in the July meeting. And then if I look through the expectation until the end of the year, investors are now expecting 2 rate cuts for this year versus 3 in the previous week. So with the very strong economic data, investors have also dialed back some of their expectations around the rate cuts. Okay, so this is what we see for the US 10-year bond yield, effectively some rebound here to now about 4.35% after reaching close to 4.2% in the previous week. Okay, likewise, that's what we see for the US 1-year bond yield, with the expectation that we may not see that acceleration in Fed interest rate cuts. The 1-year bond yield is now back above 4% once again to 4.1%. However, in Singapore, we see a very different picture. So this is the Singapore 1-year government bond yield. Effectively, it's just been on a steady decline since the start of this year. So if you are someone who has a mortgage, you'll probably be aware, especially if you're on floating rates, that the 1-year bond yield has fallen. Some of the rates that are tied to your mortgages have also come down. So that is something that we see which is different from the US bond yields. So with that, we have seen some movements in the Singapore stocks. If I was to look at the top performers in the past week, we see a number of the developers here, including Hong Kong Land up by 8.6%, UL up by 6.4%, City Developments up by 4.9%. Okay, so generally the fall in the interest rates have led to expectations that we may see a pickup in transaction volumes, and that's helped to lift the sentiment towards the property developers as well as the landlords. In terms of the worst performers, some of the industrial stocks here, including ST Engineering, Yangtze Shipbuilding, SETS, names that have done well previously, and we see some rotation then into the property names from some of these stocks that have really done very well over the past 2 years. So what I wanted to talk about today is the property sector. I mentioned that there were a few names that were the best performing stocks over the past week, including UL and City Developments. But what also came up over the past week were additional cooling measures for the Singapore property sector. So this relates to the seller stamp duty, where we see that the holding period has been extended from 3 years to 4 years, taking effect from the 4th of July 2025. And the seller stamp duty rates has been raised by 4 percentage points across all tiers. So for those who are transacting in these properties, and what we see here is that for those with a holding period of less than 1 year, the seller stamp duty has been raised from 12% to 16% on or after the 4th of July 2025. So that effectively would be then also reflected in the rates for up to 4 years. And that is effectively what we mean by that the seller stamp duty rates has been raised by 4 percentage points across all tiers. So why the property cooling measures? Because what the government sees is that there has been an increase in the short-term sales and resale of some of these properties, especially the sub-sale of uncompleted units. So if I were to look at this data here, the sub-sale actually rose to make up 6.5% of total private residential transactions in 2024, versus a low or below 2% like in 2017 to 2020. However, if I were to look at the historical comparison, this 6.5% in 2024 is still below the previous peak in 2008 when it reached as high as 13%. So I think this is really meant to be able to target some of this speculative activity that may be seen in the property market. Overall, we have seen continued increase in the property prices in Singapore based on the flash estimates announced by the URA. The private property prices were up by 0.5% quarter on quarter in the second quarter of this year. So that is a slight slowdown from the 0.8% that we saw in first quarter 2025, but still represents a continued increase. Likewise, that's what we see for the HDB resale prices that were up 0.9% quarter on quarter in the second quarter versus 1.6% in the first quarter of this year. Okay, so I think overall, I mentioned earlier that we have seen the 1-year bond yields coming down. We also see a decline in the rates that a lot of the mortgages are tied to, and this will be the SORA and 3-month SORA. With the cut in the US rates, we have seen that coming down over the past few months. And effectively, that is actually driving the concern that there will be more buying demand, which will increase the speculative activity even further. Okay, so what I wanted to share more about are two stocks, City Developments and UL. If I look at City Development share price, it actually has recovered very strongly over the past few months. We see here the hit in April because of the concerns around the trade tariffs. It recovered then to about $5 per share, and then had a slight dip thereafter as the bond yields actually climbed. And then thereafter, what we saw is that in the past few weeks, there has been a big jump in City Development share price to actually now close to $5.40. Okay, if I look at the valuation of city developments at this point in time, even with the slight recovery over the past few weeks, the price to book ratio is still at 0.55 times price to book, which is below the historical average of 0.75 times price to book. Okay, next I look at UL, another property developer name that has done well. It had a slight dip once again with the trade tariffs in April, but has definitely recovered to be now above those levels. In fact, last week before the announcement of the property cooling measures, it reached a 52-week high. And then with the property cooling measures announced, we see some correction in its share price to now about $6.50 per share. Okay, so at this point in time, UL is at 0.47 times price to book, which is still below the historical average, even though it's recovered slightly from its lows in terms of price to book, where at one point it was below 0.4 times price to book. Okay, so in terms of what I'll be looking out for this week in terms of macro, just really the FOMC meeting minutes that are coming up this week before we go into the results season, where we expect more updates from the companies on their first half results. Okay, so with that, I'll hand over to Sunny, who will share the technical analysis.
Okay, thanks, Gerald, on that coverage on UOL and city development. So if you have been following the weekly market review closely, you have noticed that since the start of the second half of this year, we have been talking much about the REITs and the property sector with the interest rate coming down. So that should be the direction that you should be watching. So we can't give any recommendation to you, but we can give you some kind of direction of what you should be looking at for the second half of the year. So talking about these Singapore counters, let us look at the STI index. So we have been continuing to push the all-time high, and this Monday morning on the 7th of July, we pushed it up to about 4,027 points. We are now hovering around 4,024 points. So where is the STI index likely to go? I think we are at a quite an elevated level for now. We reached the previous high of about 4,005 points, up by about more than 20 points now, above that high that we saw just before the April tariffs hit. So market, there might be some sellers coming in to sell this at this technical level of the 4,000 handle, and hence if you are holding any of the STI constituents, the banks or the STI index ETF, you have to watch closely and see if there is any sign of a weakness. Okay. So what I'm reading from the technical indicators, the MACD is still on is still having a positive reading, but then I could see some kind of sort of slowdown in the uptrend momentum coming in, looking at the trajectory of the MACD and signal line going in a sort of a horizontal direction. Okay, so it signals that we could the most of the rally that we should have seen due to the tariffs issues has been sort of a price in already. And hence, if you have any those counters I mentioned earlier or the STI index, if you look at the RSI, it's now at the 72-point level. And historically, when we hit above the 70 point, you can see some kind of a pullback happening on the STI index. So hence, I'd like to share with our audience that if you are holding the STI index ETF or looking at the STI index, this is a level that we should, if there is any sign of weakness, we should take some profit off the table. And as usual, wait for a pullback towards the mean or the 20 days moving average, at least now at the 3,943 points or the 4,000 handle to accumulate on the STI index again. Okay, so we are going to the earnings seasons, and some of the earnings, if let's say we continue to perform well, will of course contribute to push the STI higher. But as of now, I think if what I'm concerned about is the tariff that is pushed back to 1st August. If there's any re-escalation of those risks, then definitely we should take some profit off the table on the STI index now and wait for a pullback towards the 20 days or the 50 days moving average. Okay, next, let us move to the US indices. So we are going into the earnings season next week, and it's going to be a very close watch earnings season because so far, all the tariff actions has no impact on the macroeconomic data on the US side, especially last week non-farm payroll and the PMI data. There's no sign of weakness on the US economy. And in the previous earnings seasons, we also saw some of the companies did not provide any guidance due to the uncertainty of the US tariff. Hence, with a little bit more clarity now going into this earnings seasons, the bar might be slightly lowered. And if let's say there could be some positive guidance from the companies that could bring further upside to the US indices. So let me touch on the Dow Jones Index first, where majority of the constituents are the US major banks, which will always start the earnings seasons with their announcement. And I want to remind investors that 2 weeks back, the US bank actually had a stress test, and they have done very well in that stress test, and it paves the way for the banks to pay out higher dividends, and hence a lot of investors are eyeing that the Dow Jones Index will likely also, like the other two major US indices, hit the all-time high level of 45,073 points in the next couple of weeks when the earnings seasons come in. So the high is at 45,073 points. That is the key resistance level that we are looking at in the near term. And if let's say a pullback happened, the 20 days is now sitting at the 43,080 points level, with the 200 days moving average close by at 42,650 points. Looking at the indicators as well, MACD is showing positive momentum. The trajectory up is still strong, so there is still slightly upside still present. The uptrend momentum still present in the MACD indicator. However, you have a contradicting reading from the RSI indicator, which is now at 75 points level, 5 points above the overbought level, and hence a reminder that we should be careful. So you can see that at the beginning of the year, in the January period, when we hit the 70-point mark, we had a correction. Okay, that was before even the tariffs happened. So let's have a very close look on this. And once it hits the 45,000 level, we have to be more alert and see if there's any pullback or major seller coming in to push down the index to the average or the 20-day moving average at 43,080 points for now. Okay. Next, let's us move to the broader index, the S&P 500. So the previous high we saw was 6147 in the February period, and we have pushed it up to the 6,284 points, more than 100 points above the February high. And this is the all-time high figure that we are looking at. Looking at the indicators wise, you can see that the MACD and the signal line is trying to sort of get tangled up. That could mean that at this point of time, there could be some indecisiveness on where the market might be heading from this point. And the market is largely dependent on the next catalyst or the next data that could come in to point where the direction should be going. On the RSI indicator, the 75-point reading has also breached the 70-point mark overbought level. And hence, this is a signal that there could be a technical pullback happening on the S&P 500 index soon. Okay, so you can see that the S&P 500 index has previously been using the 20-day moving average over here at the end of June period to get a bounce. We are now tracking the upper bound of that Bollinger Band. In the May period, we also used that 20 days moving average as well to have a bounce, although that coincides with the 200 days moving average, hence it became a very strong support level. So I think the first support level we are looking at for immediate bounce will be the 6,070 points level. That is the 20 days moving average, with the lower bound of the Bollinger Band finding confluence with the 50 days moving average in blue now at 5,887 points. So that is that level, that the next level that the S&P 500 would find a firmer and further support to the rally that we have been seeing so far. Next, let us move to the Nasdaq Composite Index. So we also have a all-time high on the Nasdaq Composite Index. The previous all-time high was around the 20,200 point level, which was at the December period that we see last year. And now the all-time high stands at the 20,624 points level. Okay, so this is still a very strong performance on the Nasdaq Composite Index, but technical indicator wise, I think it's not looking any sign of it's not a picture perfect sort of a display from the technical indicators. You can see similar to the S&P 500, the trajectory of the MACD line, the signal line going into this week has been sort of a more on a horizontal basis rather than an uptrend. So that means that the upside ahead could be limited. And with the RSI now touching the 72-point level, that could mean that there could be some kind of a technical pullback at least. And that's what we also saw during the May period over here when RSI touched the 70-point level. You see a pullback towards the 20 days moving average before any bounce could happen or the uptrend would likely continue. So I think for most of the indices, the US indices and even the Singapore index, we are at an all-time high now. We need to be very cautious because this means that the greed level in the market is very high, and we are waiting for the earnings seasons to really validate this kind of valuation. And if any of those margins going to miss, then definitely there will be some kind of pullback. And hence, if you are looking at getting into the market right now, the 20 days moving average should always be the first level that you should be looking at, or even spread out your investment between the 20 days and the 50 days moving average on all the major indices. Okay, so these are the updates that I have today. Anything else to add, Gerald, on your side?
So I think we have seen markets actually reaching all-time highs. Like you mentioned, some of the indicators might appear a bit more stretched at this point in time, while investors are looking out for the developments on the trade front. So those are things that we'll continue to keep a lookout for as we enter the earnings season.
Yes, and we will keep you guys updated on the latest development on the earnings season as well as the trade tariff. So in the meantime, do stay safe and trade safe, and we'll see you again next week in the next weekly market review. Goodbye.